In a busy world, not all of us has the chance to just sit and trade all day. In fact, one of the reasons our options trading programs at NetPicks have done so well is because of the time constraints that many people face. And if you want to learn about options trading, you can shoot Mike an email here. Just let him know you're interested about options and see what NetPicks has to offer for you. But one thing that we all have time for is to look at a daily chart. We all have time to find a specific candlestick, and we all have time to look at a lower time frame chart for an entry. Right, so we're going to look at a swing trading strategy that anybody, regardless of your work schedule, your school schedule, doesn't matter, can make use of. So first thing you want to do, open up a daily chart of any instrument. Doesn't matter what it is, stocks, crypto, most anything you're interested in, you could trade. And the charts I'm going to be using are from TradingView. And before I pick the stock, I look at this website here to see which sector is doing well. Okay, then I look for a stock inside of the best sector. So for these examples, I'm going to be looking at stocks in the energy sector. Now here you see that the overall price trend is up, right? We don't need a trading indicator, but we can see that the stock is making higher highs and higher lows. That defines an uptrending instrument. The next thing we're going to look for is an inside bar. And an inside bar is just a consolidation. It's a trading range on a lower time frame. So I want you to notice the triangles below some of the candlesticks. That's a free indicator on TradingView that you can find in the public library section of it. Now, when you trade with inside bars, really, and I'll say this repeatedly, it's an underrated approach to the markets. So make sure you check out this video here. You can see a very interesting approach to profiting from this type of candlestick. Okay, so now you see you have an inside candlestick. Now we're going to look for a price to break from it. So in order to see that, we're actually going to use a lower time frame. Okay, now have some rules. Use a 1 hour or a 30-minute chart. So this is the 1 hour chart, and I've highlighted with those two horizontal black lines where the inside bar on the daily is. I've drawn a standard trend line on the highs of the candlestick. Now here the market gapped up and over the trend line on the open on that next trading day. Place a buy stop order above the high of that candlestick, and if price continues, you get taken into the trade. Now once you draw a trend line, you can consider setting an alert for when it breaks. Depends on the charting package you're using. Okay, this way you don't need to sit and just watch it all day long waiting for it to break. Your stop loss can be placed under the entry candlestick or, depending on the distance of it, around the lows of the inside day. Now the gap in this case causes a large price distance, right, if you want to use that low of the inside bar. Obviously, we'd love to see a no gap move. Taking profits. Now, there are times when markets will just run, so having a trailing stop can make sense. Now some traders, though, would rather use price structure, such as previous swing highs to take profits at. Others may want to scale out when price advances in terms of risk reward. So scale out 1, 2, 3 times your initial risk. Let's look at another stock chart, and this is just the hourly time frame. Okay, the daily chart had an inside candle set up, which you can see with the black lines. So this is what happens when price does not gap up over the trend line. It allows a smaller stop loss, which can, when you're using proper risk protocols, allow you to have slightly larger position sizing. We buy stop the high, and depending on the trader, you might just mark it in at the close of that breakout candlestick instead of using a stop order. Now this is a sell setup, and it's a pretty tough chart due to the huge momentum candle that broke the trend line. So this stock is making lower highs and lower lows on the daily chart, so making a short trade makes sense. The stop loss is quite large, and that may be something for you to consider when you're building your trade plan. Do you skip these trades? Do you take these trades but use a smaller risk percentage for your stop? I'm going to give you an adjustment later on for these big momentum candles so you can continue to play these kind of moves if it fits your trading plan. And here price did drop 3% from the entry before roaring back to where your stop would have been. So how would you manage this type of price action? We can't always expect price just to move cleanly in our favor. So here, as price makes lower highs, you could just trail your stop to the high once price begins to break down. Now, generally, you would not place your stop here at number 1 until that swing low that's leading into the 1 is broken to the downside. Now, some traders, once price makes a high and begins to fall, especially if it's broken from a range, will adjust stops when that happens. So you can see here at number 1 how price ranged and then broke to the downside. You then adjust your stop to just above that range once price has made that obvious break to the downside. Here it does reverse back up against you, but it doesn't challenge the high at number 1. What about crypto? This is ETH/USD, and just like the last chart, that breakout candlestick is huge. So why did I put the stop loss at that location? Well, this is an hourly chart, and after that breakout, dropping down to a 30-minute chart actually breaks that candle into 2 separate candles. I simply used the low of the second candle that formed on the 30-minute chart that was used to complete the hour chart. So you can even drop lower, but just be warned that price can and does retrace after breakouts. If you put it too close, you could be stopped out. And of course, if the setup is still valid, you just re-enter at the same price. Now, everyone knows about that recent run and drop of the stock AMC. Could you have been in just before the big move? So to keep it transparent, the daily chart inside bar is actually the last one before the run-up in price. So you can see that your entry, following the exact same rules we just discussed, would have been around $13.23. And you would have been in that position for that big move up. So depending on how you take profits, you'd have actually doubled your money in 4 days. Another thought about profits. How do you get into a trade? Well, it's a trendline break. Could you use that to ride the trend? Yeah. So if you would have used the trendline drawing method I outlined in this video here, you can see the link above, you actually would have enjoyed a really healthy run up in AMC. You would not be selling at the top of the move, of course, but I think anybody watching this would have enjoyed a 250% price move. I've given you a few things here to add to your trading plan. I would add 1, make sure you're not in a trading range when you're taking these trades, right? Look for an inside bar that takes place as part of a corrective swing. And yeah, it might turn into a trading range right after the trend line break on the lower time frame, but we don't know that's going to happen. And you may also encounter multiple days of inside bars. Now, if they're getting smaller or staying relatively the same size, you're actually inside the formation of a chart pattern called a triangle, right? You can learn more about trading triangles in the video here. There's a lot of opportunity inside of this trading strategy. Okay, inside bars are a consolidation. A trend line measures the rhythm of the market. So what you're essentially trading is a break from a range, a change in the market rhythm, and that can lead to a pretty profitable trading strategy. Just do your work and test this and make your rules. Hope you enjoyed the video. Like, subscribe, any comments, put them below. And of course, I'll get back to you.